Hey guys, my name is Faizi and this video is going to be a short overview of ASX A200 ETF. Before we get into it, this video is not financial advice. I'm not a financial advisor. We are speaking in a very general sense only. I just have a passion for investing, same as you, so let's get into it. So A200 is the BetaShares Australia 200 ETF, and basically the aim of this ETF is to give you capital appreciation, portfolio diversification, and you can get exposure to the 200 largest companies on the ASX at an ultra low management fee of just 0.04%. Now, some benefits of this ETF are obviously the ultra low cost that we just spoke about. Now, 0.07% per annum turns out to be $7 fee per $10,000 invested, which is very dirt cheap. In fact, according to Bloomberg, A200 is the world's lowest cost Australian shares ETF, so there you go. Now, this fee gets charged annually, but just keep in mind that this is not an out-of-pocket expense. Now, with these broad market ETFs, generally you'll find that most fees are below 0.1%, so this ETF fits quite well in that price point. Now, the second benefit is the portfolio diversification, so you're basically getting access to 200 of Australia's companies just by buying this one asset, instead of individually buying each of those 200 companies. Now, the third benefit is that you can form this as part of your overall investing strategy, meaning that you might want to have a small percentage of your portfolio in this ETF, or you might want to have a lot of it. It's up to you. Now, let's quickly have a look at the returns for this ETF. So the 5-day return is about 0.77%. Looking at the 6 monthly return, it is somewhere around 12.18%, which is quite good. Looking at the 1-year return, is somewhere around 16.6%, and looking at the rough 2 years return, it is somewhere around 12.5%. Now, these returns are all good, but let's find out the compounded annual return for this ETF. Now, this is a compounded annual growth rate calculator, or the CAGR calculator. Now, the starting value is gonna be $191, so let's just put that in. And the value of the ETF 3 years later, not 2, sorry, my bad. So value of the ETF roughly 3 years later is 113.47. So let's put that down. And in the years, we're going to put 3 years. Now, the annual compounded growth rate we've got here is 4%, which might not actually seem that attractive, but it is still more than a savings account. Now, as I've mentioned in other videos as well, the market generally returns between 7 to 10% per year. However, as you guys can see, for the last 3-ish years, the return has been about 4% for this ETF. Now, just keep in mind that these returns are not guaranteed in any way. However, the market tends to trend upwards. Now, guys, if you want to get started with investing, you can check out either Perla or Self Wealth. It's up to you. Both of these brokers are CHESS sponsored and they charge $9.50 per trade. But I recommend Perla out of these two brokers because you can set up auto invest, which means that you can basically automate your investing and keep investing at regular intervals without worrying too much of what the market is doing, and you'll basically be focusing on dollar cost averaging into your positions. Now, there's a link in bio for both of these platforms for you to get started, so good luck. All right, now let's look at some other information about this ETF. So here you've got the net assets and the units outstanding. Now, if you divide the net assets by the units outstanding, you will get the net asset value, which is around here. The management costs are 0.07%, as we spoke about earlier, and the distribution frequency is quarterly, meaning that you will get paid a quarterly dividend. Now, this is quite good because usually the companies on the ASX pay a semi-annual dividend, meaning that you get a dividend twice a year. But with this ETF, you'll get a dividend about 4 times a year. So this is a bit of a bonus. So the ASX code is A200, as you guys know about, and you've got the trading hours, which are between 10 to 4 p.m. This is all pretty standard. Now let's look at the portfolio holdings, which are arguably the most important part of any ETF. So here you guys can see that the largest holding is CBA, which is 8.2%. And then you've got BHP, CSL, Westpac, and a few banking stocks down there, and some other stocks as well. Now, the reason why you guys see so many banking companies over here is that the largest sector in the Australian economy is banking, followed by materials, which is mining. So this ETF is basically showing a snapshot, a bit of a reflection of our economy. Now, this is the reason why you have companies like BHP and Rio on the list as well as top 10 holdings. One important thing to note is that CBA is given the highest weighting in this ETF at about 8.2%, followed by BHP at about 7.6%. However, if we look at the market cap of these two companies, BHP is actually larger than CBA, but CBA still has a higher weight. So basically what I'm trying to say is that the market cap of these companies won't necessarily determine the weight of the company when it comes to ETFs. So looking at the sector allocation, we can see that the ASX200 is almost 50% skewed towards financials and materials, because you've got 28.7% in financials, then 20.2% in materials, and you've got very little allocation in IT, which is only 4%. Now, if we compare this ETF to ASX IVV, this is the S&P 500 ETF listed on the ASX, which tracks the American market. You can see that IT is the biggest sector at about 27%. So if you guys want to get further diversification, also think about investing in other economies as well. Now, if you guys want to know more about IVV, I've done a quick overview just like this one for that ETF, and that video explains everything about it. So there should be a link in description, and there should be a pop-up on your screen as well right now. Now here we can see the returns after fees, and we already went into this a little bit, but you guys can see it here again. Now, one important thing to note is that this ETF has only been listed since 7th of May 2018, just under 3 years, so the average return can still change. So this return that we calculated was only 4%, and this doesn't actually include the quarterly dividends that we spoke about earlier. So if you add in the capital gain plus the dividend, your return will be higher. And here we've got the 12-month distribution yield, which is somewhere around 2.1%. Now, it's important to also note that ASX has one of the highest dividend yields in the entire world. In fact, it's more than America, so generally speaking, you will get a higher dividend yield in Australia. Now, this ETF does have a few negatives though, and that's the fact that it's not really diversified because 50% of the holdings are in financials and materials. Now, this isn't the fault of BetaShares or this ETF itself, because this ETF is just tracking the index, but the composition of this current sector allocation does leave out some room for growth in other sectors of the market. The biggest sector being tech, at least that's my opinion. And the other thing is, you are only investing in the Australian market in this ETF, which leaves out a lot of room for growth in other sectors of the world like the US or even Asia. Now, if you want to get started with investing in Asia through ETFs, I've made a video over here that goes over the top 4 ETFs that you can consider to diversify your portfolio. And this video talks about ASX IVV, which we spoke about in this video, and this ETF tracks the S&P 500 over in America. Thanks for watching, guys. Please like and subscribe, and I'll see you in the next one. Bye now. Now, if you guys remember the